A mortgage loan, also referred to as a mortgage, is used by purchasers of real property to raise funds to buy real estate, or by existing property owners to raise funds for any purpose while putting a lien on the property being mortgaged. The loan is secured on the borrower's property. This means that a legal mechanism is put in place which allows the lender to take possession and sell the secured property to pay off the loan in the event that the borrower defaults on the loan or otherwise fails to abide by its terms. The word mortgage is derived from a law French term used by English lawyers in the Middle Ages meaning death pledge, and refers to the pledge ending when either the obligation is fulfilled or the property is taken through foreclosure. Mortgage can also be described as a borrower giving consideration in the form of a collateral for a benefit. Mortgage borrowers can be individuals mortgaging their home, or they can be businesses mortgaging commercial property. The lender will typically be a financial institution, such as a bank, credit union or building society, depending on the country concerned, and the loan arrangements can be made either directly or indirectly through intermediaries. Features of mortgage loans such as the size of the loan, maturity of the loan, interest rate, method of paying off the loan, and other characteristics can vary considerably. The lender's rights over the secured property take priority over the borrower's other creditors, which means that if the borrower becomes bankrupt or insolvent, the other creditors will only be repaid the debts owed to them from a sale of the secured property if the mortgage lender is repaid in full first. In many jurisdictions, though not all, it is normal for home purchases to be funded by a mortgage loan. Few individuals have enough savings or liquid funds to enable them to purchase property outright. In countries where the demand for home ownership is highest, strong domestic markets for mortgages have developed. Mortgage loan basics. Basic concepts and legal regulation. According to Anglo-American property law, a mortgage occurs when an owner pledges his or her interest, his security or collateral for a loan. Therefore, a mortgage is an encumbrance on the right to the property just as an easement would be. But because most mortgages occur as a condition for new loan money, the word mortgage has become the generic term for a loan secured by such real property. As with other types of loans, mortgages have an interest rate and are scheduled to amortize over a set period of time, typically 30 years. All types of real property can be, and usually are, secured with a mortgage and bear an interest rate that is supposed to reflect the lender's risk. Mortgage lending is the primary mechanism used in many countries to finance private ownership of residential and commercial property. Although the terminology and precise forms will differ from country to country, the basic components tend to be similar. Property. The physical residence being financed. The exact form of ownership will vary from country to country, and may restrict the types of lending that are possible. Mortgage. The security interest of the lender in the property, which may entail restrictions on the use or disposal of the property. Restrictions may include requirements to purchase home insurance and mortgage insurance, or pay off outstanding debt before selling the property. Borrower. The person borrowing who either has or is creating an ownership interest in the property. Lender. Any lender, but usually a bank or other financial institution. Principal. The original size of the loan, which may or may not include certain other costs. As any principal is repaid, the principal will go down in size. Interest. A financial charge for use of the lender's money. Foreclosure or repossession. The possibility that the lender has to foreclose, repossess or seize the property under certain circumstances is essential to a mortgage loan. Without this aspect, the loan is arguably no different from any other type of loan. Completion. Legal completion of the mortgage deed, and hence the start of the mortgage. Redemption. Final repayment of the amount outstanding, which may be a natural redemption at the end of the scheduled term or a lump sum redemption, typically when the borrower decides to sell the property. A closed mortgage account is said to be redeemed. Many other specific characteristics are common to many markets, but the above are the essential features. Governments usually regulate many aspects of mortgage lending, either directly or indirectly, and often through state intervention. Other aspects that define a specific mortgage market may be regional, historical, or driven by specific characteristics of the legal or financial system. Mortgage loans are generally structured as long-term loans, the periodic payments for which are similar to an annuity and calculated according to the time value of money formulae. The most basic arrangement would require a fixed monthly payment over a period of 10 to 30 years, depending on local conditions. Over this period, the principal component of the loan would be slowly paid down through amortization. In practice, many variants are possible and common worldwide and within each country. Lenders provide funds against property to earn interest income, and generally borrow these funds themselves. The price at which the lenders borrow money therefore affects the cost of borrowing. Lenders may also, in many countries, sell the mortgage loan to other parties who are interested in receiving the stream of cash payments from the borrower, often in the form of a security. Mortgage lending will also take into account the riskiness of the mortgage loan, that is, the likelihood that the funds will be repaid, that if they are not repaid, the lender will be able to foreclose on the real estate assets, and the financial, interest rate risk and time delays that may be involved in certain circumstances. Mortgage underwriting. Once the mortgage application enters into the final steps, the loan application is moved to a mortgage underwriter. The underwriter verifies the financial information that the applicant has provided to the lender. Verification will be made for the applicant's credit history and the value of the home being purchased. An appraisal may be ordered. The financial and employment information of the applicant will also be verified. The underwriting may take a few days to a few weeks. Sometimes the underwriting process takes so long that the provided financial statements need to be resubmitted so they are current. It is advisable to maintain the same employment and not to use or open new credit during the underwriting process. Any changes made in the applicant's credit, employment, or financial information can result in a loan being denied. Mortgage loan types. There are many types of mortgages used worldwide, but several factors broadly define the characteristics of the mortgage. All of these may be subject to local regulation and legal requirements. Interest. Interest may be fixed for the life of the loan or variable, and change at certain predefined periods. The interest rate can also, of course, be higher or lower. Term. Mortgage loans generally have the maximum term, that is, the number of years after which an amortizing loan will be repaid. Some mortgage loans may have no amortization, or require full repayment of any remaining balance at a certain date, or even negative amortization. Payment amount and frequency. The amount paid per period and the frequency of payments. In some cases, the amount paid per period may change, or the borrower may have the option to increase or decrease the amount paid. Prepayment. Some types of mortgages may limit or restrict prepayment of all or a portion of the loan, or require payment of a penalty to the lender for prepayment. The two basic types of amortized loans are the fixed-rate mortgage and adjustable-rate mortgage. In some countries, such as the United States, fixed-rate mortgages are the norm, but floating-rate mortgages are relatively common. Combinations of fixed and floating-rate mortgages are also common, whereby a mortgage loan will have a fixed rate for some period, for example the first 5 years, and vary after the end of that period. In a fixed-rate mortgage, the interest rate remains fixed for the life of the loan. In case of an annuity repayment scheme, the periodic payment remains the same amount throughout the loan. In case of linear payback, the periodic payment will gradually decrease. In an adjustable-rate mortgage, the interest rate is generally fixed for a period of time, after which it will periodically adjust up or down to some market index. Adjustable rates transfer part of the interest rate risk from the lender to the borrower, and thus are widely used where fixed-rate funding is difficult to obtain or prohibitively expensive. Since the risk is transferred to the borrower, the initial interest rate may be, for example, 0.5% to 2% lower than the average 30-year fixed rate. The size of the price differential will be related to debt market conditions, including the yield curve. The charge to the borrower depends upon the credit risk in addition to the interest rate risk. The mortgage origination and underwriting process involves checking credit scores, debt-to-income, down payments, and assets. Jumbo mortgages and subprime lending are not supported by government guarantees and face higher interest rates. Other innovations described below can affect the rates as well. Loan-to-value and down payments upon making a mortgage loan for the purchase of a property. Lenders usually require that the borrower make a down payment, that is, contribute a portion of the cost of the property. This down payment may be expressed as a portion of the value of the property. The loan-to-value ratio is the size of the loan against the value of the property. Therefore, a mortgage loan in which the purchaser has made a down payment of 20% has a loan-to-value ratio of 80%. For loans made against properties that the borrower already owns, the loan-to-value ratio will be imputed against the estimated value of the property. The loan-to-value ratio is considered an important indicator of the riskiness of a mortgage loan. The higher the LTV, the higher the risk that the value of the property will be insufficient to cover the remaining principal of the loan. Value, appraised, estimated, and actual. Since the value of the property is an important factor in understanding the risk of the loan, determining the value is a key factor in mortgage lending. The value may be determined in various ways, but the most common are actual or transaction value. This is usually taken to be the purchase price of the property. If the property is not being purchased at the time of borrowing, this information may not be available. Appraised or surveyed value. In most jurisdictions, some form of appraisal of the value by a licensed professional is common. There is often a requirement for the lender to obtain an official appraisal. Estimated value. Lenders or other parties may use their own internal estimates, particularly in jurisdictions where no official appraisal procedure exists, but also in some other circumstances. Payment and debt ratios. In most countries, a number of more or less standard measures of creditworthiness may be used. Common measures include payment to income, debt to income, and various net worth measures. In many countries, credit scores are used in lieu of or to supplement these measures. There will also be requirements for documentation of the creditworthiness, such as income tax returns, pay stubs, etc. The specifics will vary from location to location. Some lenders may also require a potential borrower have one or more months of reserve assets available. In other words, the borrower may be required to show the availability of enough assets to pay for the housing costs for a period of time in the event of the job loss or other loss of income. Many countries have lower requirements for certain borrowers, or no-doc, low-doc lending standards that may be acceptable under certain circumstances. Standard or conforming mortgages. Many countries have a notion of standard or conforming mortgages that define a perceived acceptable level of risk, which may be formal or informal, and may be reinforced by laws, government intervention, or market practice. For example, a standard mortgage may be considered to be one with no more than 70 to 80% LTV and no more than one-third of gross income going to mortgage debt. A standard or conforming mortgage is a key concept as it often defines whether or not the mortgage can be easily sold or securitized, or, if non-standard, may affect the price at which it may be sold. In the United States, a conforming mortgage is one which meets the established rules and procedures of the two major government-sponsored entities in the housing finance market. In contrast, lenders who decide to make non-conforming loans are exercising a higher risk tolerance and do so knowing that they face more challenge in reselling the loan. Many countries have similar concepts or agencies that define what a standard mortgage is. Regulated lenders may be subject to limits or higher risk weightings for non-standard mortgages. For example, banks and mortgage brokerages in Canada face restrictions on lending more than 80% of the property value. Beyond this level, mortgage insurance is generally required. Foreign currency mortgage. In some countries with currencies that tend to depreciate, foreign currency mortgages are common, enabling lenders to lend in a stable foreign currency, whilst the borrower takes on the currency risk that the currency will depreciate and they will therefore need to convert higher amounts of the domestic currency to repay the loan.